Hey guys, welcome to the channel. Today we're going to be talking about interest. Now, what is interest? The basic definition of interest is the amount of money paid to use someone else's money, and that can be in the form of a loan or deposit, and it's expressed typically as a percentage of the amount of money which is being used. So that's a basic definition. Now, why are we charged to use someone else's money? Why do we have to pay interest on our student loans, on our mortgages, credit card bills? And at the same time, why do we receive interest on our deposits? And more importantly, what determines how much interest we have to pay to use that money? Now, in terms of deposits, that's a relatively straightforward explanation. So banks, in order to carry out their banking activities, they need to raise cash. Okay, they need to raise cash so that they can then make loans to individuals or to businesses. And one way to do that is to encourage us, so me and you, to deposit our hard-earned cash into savings account and to have our salaries paid into their current accounts. So what would happen is we'd typically go out on the high street, we'd compare all the different accounts and see what their offers are, and we'd usually go with whichever bank is offering the best rate. So that is why we receive interest on our deposits. The banks are trying to incentivize us to deposit our cash with them so that they can then use it for their general banking activities. Now, why are we charged interest on our loans? There are a number of reasons for that. Today we will be talking about four, and that is the cost of funds, opportunity cost, inflation, and credit risk or counterparty risk. Now let's look at cost of funds. So as we just mentioned, banks, they make loans by raising cash in the form of deposits, but they can also raise this cash by borrowing in the short or long term from investors or other financial institutions. And just like with deposits, there's an associated cost for raising that cash. So they have to also pay whoever they're raising that cash from, so either in financial institutions or institutional investors, they have to pay them a certain amount of interest to use that money. So the cost of funds represents how much it costs them to raise the cash that they'll then use to make loans to businesses and individuals, and that's where the bank will make their profit from those loans. So let's take an example. If we are being paid 1% on our deposits, and then the bank uses those deposits to extend a loan out to a business, if they only charge that business 0.5%, then that bank will be making a loss because they're having to pay us 1% on our deposits, but they're only receiving 0.5% on the loan that they've extended to that business. So in order to break even, they'd have to charge at a minimum 1% on that business. But of course, banks have other costs. They have their employee salaries, they have their office rents, and they have their shareholders who expect a certain return on their equity. So if a bank is only breaking even on all of their loans, that bank isn't going to be around for a long time. So that is the cost of funds element of the interest. So there's an associated cost with raising the cash that they use to extend the loans. So they have to cover that cost. Now let's look at opportunity cost. What is opportunity cost? Opportunity cost is what you are missing out on by choosing one alternative over another. So for example, if I have the choice between option A and option B, clearly if I go with option A, then I'll miss out on all of the exclusive benefits that I would have received had I gone with option B. So how does this relate to our lending scenario? Well, if I'm lending you, let's say £10,000, I can no longer use that money. I can't benefit from it, I can't spend it, I can't use it to go on a nice holiday or to buy a car, and I can't invest it either. So I may have heard of a up-and-coming company that I could have invested in, and depending on how well that company performs, that £10,000 could have grown into 15, 20, £30,000, if not more, depending on how well that company performs. So I'm missing out on all of these opportunities by lending you this money, so I need to be compensated for that. And one way to do that is to charge interest. So that is opportunity cost, and there's opportunity cost in all aspects of life. It's not only related to money. So I'll give you an example. University, there's an associated opportunity cost with going to university, and I'm not referring to the tuition fees, because you go to university, you have to pay tuition fees. The opportunity cost of going to university, or a non-money related opportunity cost for going to university, is not being able to work full-time for the next 3 or 4 years. As a full-time student, you're not in a position to obtain that 3 to 4 years of work experience that you could have put on your CV, which could potentially make you more attractive to future potential employers. Now it's up to you to weigh up the pros and cons to determine whether it's worth missing out on those 3 or 4 years of work experience to obtain your degree. You might think that in the long term, having graduated with a degree, I'll be in a better position than had I gone straight into work after school. So that is opportunity cost. It's you are missing out on certain opportunities because you've lent someone the money, so you need to be compensated for that. Now let's talk about inflation. Now the definition of inflation is the rise in the price of goods and services over a period of time, and typically this is measured on a yearly basis. And in a well-functioning, strong economy, you'd want to have positive inflation. And the central banks around the world, they tend to target the 2% level. So what does this mean in our lending scenario? Well, a positive rate of inflation means money today is worth more than money in the future. In other words, £100 today is worth more than £100 in the future because prices are constantly increasing. So the purchasing power of £100 diminishes as time goes on. So if I was to buy a car today which costs £10,000, the same make, model, brand in 5 years' time, ignoring any technological improvements, should cost more than what I paid for 5 years ago. Now, how does this relate to our lending situation? Well, clearly, if I lend you £10,000 and in 5 years' time you pay me back £10,000, I'm missing out again because the £10,000 that I gave you 5 years ago was worth more than the £10,000 that I'll receive at the end of the loan. So I'm missing out due to inflation, and one way to counter the impact of inflation is to charge interest. So once I've added up all of the individual interest payments plus the amount that you return to me at the end of the loan, I should be made whole and I wouldn't have missed out. I wouldn't be out of pocket because of the effects of inflation. So that is the inflation element. Finally, let's discuss credit risk or counterparty risk. Now, credit risk is the risk that you are running when you lend someone money that they will not be in a position to pay you back at the end of the loan. And this risk will depend on who you are lending your money to. So if you are, for example, lending money to a household name such as Coca-Cola, chances are Coca-Cola will still be around in 5 years' time. They're a well-established brand, they have a relatively large market share, so you can lend that company money and you can be confident that they'll be around in the next 5 years to pay you back. Now, if you were considering lending money to a startup, a tech company, for example, that's a much riskier investment because the tech industry is very volatile, very disruptive. It's not guaranteed that that company will be around in the next 5 to 10 years. So the interest that you should charge them will be much higher than the interest that you would charge a household name such as Coca-Cola. So it goes back to that old saying, the risk-reward equation. The higher the risk, the higher the reward. And it'll be up to you to make the right assessment to determine what the correct amount of interest is to charge them. And that will depend on a number of factors such as the type of company, the industry that they operate in, and what their intentions are with the loan. So are they going to invest it wisely so that they can generate additional value and additional income, which will make it then easier for them to repay you at the end of the loan. So that is the credit risk element of interest. There is a risk that the individual or the business that you are lending the money to will not be in a position to pay you back, so you charge a certain amount of interest to protect yourself against that outcome. So just to recap some of the factors that can impact the level of interest rates. So you have the cost of funds, which is the cost that banks need to pay in order to raise the cash that they will then use to extend loans to businesses and individuals. You have the opportunity cost, which is the cost of not being able to pursue other investments or opportunities because you have lent out the money. You have inflation, which means that money today is worth more than money in the future. So to counteract the impact of inflation, I charge interest. And finally, you have credit risk. there's a risk that the borrower will not be around or in a position to repay you at the end of the loan. Thank you for listening. I hope some of you have found this video useful, and if anything wasn't clear or if you have additional questions, then feel free to leave those in the comment section and I'll do my best to respond to them.